In this video, I want to look at an important aspect of pension planning, the annuity. Lots of jargon, so let's deal with that and look at how these work and where they fit into retirement planning. So, what type of pension am I talking about first of all? This is not the state pension, the final salary pension scheme offered by many employers. Annuities are most relevant to people who have what's called a money purchase scheme, and that's where regular contributions go in to a pension fund and you get a pot of money at the point you want to retire. The size of that pot being influenced by the contributions you've paid in plus tax relief, any growth you receive on the underlying investments minus charges. Now, I'll deal with all of this in more detail in another video called How Pensions Work, but that is the style of pension we're talking about. It's what you do with the pot of money, which is where annuities kind of come in. Now, just a reminder that your current choices in terms of that pot of money are as follows. There are basically three. You can take the whole fund out as cash, 25% of it is tax-free, and the rest is taxed as income. Two problems with going down route one. One is you won't have anything to live on in retirement if you spend a lot, and secondly, the tax bill in the year you do it could be pretty high. Again, more detail in other videos. Route two, take smaller lump sums out, in which case for each lump sum that you withdraw, the first 25% is tax-free and the rest is taxed as income. And you've got to kind of manage it yourself in terms of the speed you withdraw money. Option three, therefore, take the first 25% tax-free or up to the first 25% and the rest can pay you an income. Now, the way that can be organised is via a couple of products. One's called drawdown, which is where you leave the money invested and draw income off it. And the other one is the one I want to deal with here, the one that's got a bad press, the annuity. But in many ways, of all the things on that slide, the annuity for many people represents both the simplest and the most sensible way of going about the challenge of funding their retirement. And that's why I want to focus on annuities here. Now, key things to remember, whatever choice you make. You could be retired based on current estimates for another 20 or 30 years. There's quite a long time we've got to make sure we're generating a retirement income over. You need a source of income through the whole period, and towards the end, don't forget your costs can rise if you're paying for extra care and so on. Looking at routes 1 and 2 and even the drawdown route, a lot of people don't want the hassle of managing their own investment portfolio and working out how much income to draw off, which is why annuities by default for a lot of people remain quite a useful tool for at least part of their investment portfolio and or part of their retirement. But whatever you're going to do, seek professional advice first, all right? And don't listen to the headlines that suggest that annuities have kind of died. They haven't. Now, annuity basics. The deal is superficially simple. It's the choices you have to make and the jargon that can make it seem complicated. You hand over a lump sum to an annuity provider, let's call that a life assurance company, and they pay you a regular income in return. But it's the choices around how you want that income that heavily influence how much you get and make these things a little bit fiddly and still something, you know, to take professional advice on. Now, pros and cons. What are, given the headlines, what are the good things about annuities? Well, they provide a secure income for the rest of your life. You don't have to worry about managing an investment portfolio, drawing income off yourself. It's all kind of done for you, if you like. Any underlying investment risk is borne by the provider. So the provider of the annuity worries about whether the lump sum you've given them is enough to pay for your retirement. That's their problem, not yours. That makes them simple to manage on your side, and there's more and more flexibility. The old rule that said you've got to take them by 75, you've got to buy an annuity by 75 is gone. More recently, we've had the maximum guarantee period of 10 years lifted, and there's even now proposals around selling your annuity in the open market, whether or not that's a good idea. On the downside, all the headlines tend to focus on annuity rates being very, very low at the moment. I'll talk about that in a bit more detail in a moment. The terms can be inflexible. It's a kind of locked-in deal, although there is more flexibility coming in. The annuity provider will benefit if the investments rise, so it's kind of a gamble. All right, if the underlying pot increases in value, you don't really see the benefit, and they can be poor value for people who miscalculate, if you want to see it that way, die early and don't have a guarantee locked in. So, pros and cons. Now, why are annuity rates so low? This is not an economics lecture, but just a rough flavour. First of all, the bank rate to which they're linked is at an all-time low at the moment and can only really go up, but it is very low at the moment. And unfortunately, that influences the main product government IOUs that annuity providers rely on to provide you with your retirement income. And the reasons for that are well known. There's been a lot of safe haven demand for government IOUs because they're government backed, and central banks have been piling in to buy them, reducing the supply and reducing the return you therefore get on them. So for those two main reasons, I'm afraid annuity rates are pretty low at the moment. Now, that said, there are ways that you can influence the amount of income a provider will pay you. This isn't advice on the left-hand side, it's just things to think about and things to discuss, basically, when you take professional advice. So, setting your retirement date later will boost the income you receive initially for fairly obvious reasons, because the provider's got to pay you for less time. The minimum guarantee period can be a good idea, but it will cost you. All right? That's the idea that you basically force the annuity provider to guarantee the income they pay over a set period, even if you die before that period's up. Inflation linking will reduce the amount of income that you receive at the beginning, but it may still be a good idea. That's the idea that you get an inflation uplift every year in the income you receive. Okay, that, I'm afraid, does make the deal a little bit more expensive for the provider and drops the initial amount of income you receive. Joint rather than single life. So if you want the annuity to be available after your death, potentially to a spouse, for example, that, I'm afraid, does add cost to the provider and reduce the amount of income you'll receive. And finally, medical ill health grounds. That's worth knowing about. There are ways you can increase your annuity income if, for example, you suffer ill health, you're a heavy smoker, lifestyle choices and so on. So those are worth flagging up to make sure you get the maximum income that you're due. Now, just to look at that, this is an example taken from April 2015. If you were 55 years old with a £100,000 fund and you'd already taken your tax-free cash, just look at what some of those choices do to the level of income that you receive. If you go for just an annuity for you, it's called single life, no inflation uplift and no guarantee period, okay, should you die earlier than you expect, then £100,000 buys around 4,400 of annual income. And my point is not the absolute numbers, it's look what some of the choices I just mentioned do to that. So if you go for a 5-year guarantee, this is, remember, age 55, nothing much changes. But really things do start to change. If you go for inflation linking of that income, it starts from a much lower number. So you're going to start with just over £2,000, but it will rise with inflation every year thereafter. Okay, but look at the price you're paying. You've kind of halved the amount you get, and that's why that's a fairly crucial decision. That's definitely one to discuss. If you go for a straight 3% escalation, because the RPI could be anything, then you get a little bit more, which tells you what annuity providers think about the path of future inflation, for example. And if you go for a deal whereby a spouse can benefit up to, say, the value of half of the annuity, but with no guarantee, with the 3% escalation, so these two are linked, you get £2,500. Now, my point is not to baffle you with numbers, it's just to say that those decisions I mentioned are important. They affect directly the level of income you're going to get initially from an annuity provider. Okay, final message there, shop around. Don't take the first deal you're offered and don't be bullied into taking a deal from your existing life assurance company. Now, just going to finish with a new provision. This is the idea of selling annuities. The April 15 budget introduced this idea that you could sell a poor annuity deal back to an insurance company and get a lump sum. Sounds fabulous, probably won't work out for most people. Why not? Because if you got a bad deal in the first place, no one's going to take it off you and turn it into a good deal. In other words, it's a bit like buying a car. If you buy a bad, crappy car, try and sell it subsequently, you're not going to get a fabulous price unless you're incredibly lucky. Same applies to trying to sell an annuity that wasn't a great idea in the first place. So my advice there is, for most people, that's probably not a good idea, but do chat it through with someone before you make the decision. Okay, that was a lightning tour of annuities Any questions, please send them to the usual place.